This is a money guy echo that we've said over and over and over again. But one of the biggest mistakes that we see people make is not starting to save and invest soon enough.
I saw a stat, Bo, and it kind of caught me off guard a little bit, is that the average American doesn't even start saving and investing until their age 33.
You'd combat that with a statistic that 40% of Americans right now have no money invested, and we have two things going on. People that actually do save are waiting, and a lot of people never even actually get to that place either.
Well, what I hate is that you're leaving the most powerful thing that can work for you in this journey to building wealth. Compounding growth.
That's it.
And by the way, the more you defer, the more you put on your shoulders. And we have proof of this. We can show you the power of starting early.
Yeah, we talk about this all the time, Brian. You said, and you wrote about this in Millionaire Mission, that you had your Morrow moment where Mr. Morrow said, hey, if you guys could just save $100 a month, you could be a millionaire. But we know the numbers are actually even a little better than that. For 20-year-olds right now today, if you can start early and your goal is to be a millionaire, by the time you get to retirement, you would only have to save $95 a month. That's it. Less than $100 a month today to be a millionaire by the time you retire.
But here's what people don't understand. If you just delay this, for a 20-year-old, it's only $95 a month. But for a 30-year-old, it's $340 a month. So we've almost made this 4 times harder just by deferring for 10 years. And I get it. In your 20s, you don't have a lot of money, but it 4 times harder, that's something that you need to pay attention to. And how about this? What if you just defer and procrastinate so much that you wait until you're 40? Now you have to save over $1,000 a month. It is 10 times harder to become a millionaire if you defer and wait until you're 40 versus if you just started doing something when you were age 20.
So the earlier you start, the easier the journey is. The later you start, the harder it becomes. So what should you do instead if you don't want to make that mistake? You need to get started early. We say this all the time, Brian. The absolute best time to start investing was yesterday, which means by default, the second best time to start saving and investing is right now today.
Now, what I like is that we're going to show you, we've already talked about the benefit of starting early, but let's talk about the younger you start, the less you need to save. And actually, you have to decide, who do you want to do the hard work, to do the heavy lift? Do you want it to be you and your savings rate, or do you want to give it the power of time so that the compounding growth actually does the heavy lift for you?
Yeah, because again, let's think about this idea, this case study of being a millionaire. We've already said that for a 20-year-old, if you save $95 a month every month for the rest of your career, you can get to $1 million. And when you get to that million, do you recognize 95% of your account value, $950,000 of that million is all growth, is all earnings.
People aren't even going to believe that.
It's your money working. But the longer you wait, the later you get, the worse the story becomes.
Yeah, I mean, did y'all hear that? Of that $1 million, only $51,000 is your contribution. 95% comes from the growth. If you deferred and just waited until you're age 40, $234,000 of your $1 million is coming from you. The other $766 is coming from the growth. Still 77%.
Still
pretty
impressive.
Incredible. But if you wait until you're 50, now, man, you've really pushed this. Now, $446,000 of the $1 million is you. $554,000 is the growth. And then if you just wait until you're 60, you can quickly see that now you're 783,000 of it, or pretty much all of it is you, and only 200,000 is growth. Start soon and don't rest on how much your time is worth.
I've heard you say this before, Brian, that if you figure this out, time can be your absolute best ally. But if you wait, it begins working against you, and the numbers show that. So if the first mistake, Brian, was not starting early enough, I think this mistake number 2 is going to throw people for a loop. You've already alluded to this. But our second mistake that we see is people starting too soon.
Now, wait a minute, Bo. You're giving me mixed signals. You just told me people are deferring and waiting too long. Now we're saying the second mistake is people are starting too soon. What in the world could you possibly mean?
Yeah, what we want is we want you saving, investing. We want you building for your future, but only after the point that you've figured out, how do I mitigate the risks in my life that could derail my entire financial life. So often people wait. But on the other side of that coin, there are people who it's the very first thing they do when they start out, and they don't realize that they're building their financial foundation on a fragile base.
Well, that's what we're talking about is the things that can come out of nowhere on a Tuesday afternoon that can devastate your financial life. So you might be thinking, hey, I got excited. These guys got me started to save and invest early. But if you're not covering the basics, because here's the reality. It is a $30,000 thing if you had to stay in a hospital for 3 days. So you can quickly see if you don't have insurance, if you don't have an emergency reserves or something just to keep you from desperate decisions, even though you might have the greatest intent in the world, you could have an emergency that could derail your financial life forever.
So then the question becomes, okay, if I don't want to start too soon, how do I know when to start? What's my roadmap? What's my guide? We have built the guide for you. It's called the Financial Order of Operations. It's a 9-step process to walk you through exactly what you should do with your very next dollar. So as you're working through this, if you make it through step 1, and then you make it through step 2, and then you make it through step 3, you can eventually get to the point to where you should be saving and investing, but only after you've covered those bases first.
Well, and a lot of people go, they might not be familiar with the Financial Order of Operations. So I'll just go and tell you what this does is, like, step number 1 is insurance deductibles, your highest deductible coverage. So that way it's taking that one off, like the hospital stay, off the table. That then frees you up to where if your employer is offering you 50 cents on the dollar or dollar for dollar match, that 50% or 100% guaranteed rate of return, you're going to immediately maximize that with step 2. This also protects you from step 3. What if you have high interest credit card debt? This is going to protect you. You can quickly realize we've created a better mousetrap. There is a better way to do money so that you can minimize the risk, but you can go into investing freely and clearly and know that you're not starting too early, but you're maximizing the power of compounding growth.